Good afternoon and welcome to this afternoon's episode of Expert Insight. Slightly different time. We're playing around a little bit with our timelines. It's 1:30. Thank you for those who are sacrificing a little bit of their lunchtime to join us. We have a very, very interesting topic and becoming extremely relevant if you look at what's happening in our country with weather and flood damages and storms and all the other types of elements that can affect one's development, whether it's a residential community that's under development, a mixed-use development, commercial, etc., or if you're an existing estate that is busy with a new phase and that's under development. The question that comes up is insurance. And if you speak to the folks in the KZN region and those down in George, at the end of last year, they are leaning very heavily on their insurance policies right now. And I know the OUTsurance team has been very busy tackling some of those challenges. So what we're looking at specifically today is the cover that is required for the development period. So we're going to give a nice overview of what those policies look like, the timelines and where they apply, and then, of course, how you can maximize the value and minimize unnecessary costs. So before I introduce our panelists, just a little bit of housekeeping. A lot of you participated in our webinars before, but I'll quickly run through it. This webinar is recorded and we will be sharing that recording by Monday. And so you should be receiving the recording. You'll be able to view it at your own leisure. For those who requested the recording, they'll receive it as well. At the bottom of the box is a little chat. You can click on that, select the option of everyone, and that's where you can place your questions, which we will do our best to tackle over the next 45 minutes. This is a discussion-styled webinar, so we're able to move between our discussion and your questions. You can also please keep it on everyone so we can all see it. There will be a number of polls that come up. It would be great if you could answer it. It's for market research. One has come up now. Once you've answered it, just click on the red toggle. Ashwin, you can click on the toggle as well and get it out of your line of sight so that it doesn't disturb the conversation. So as I've mentioned, today's panelist is a gentleman by the name of Ashwin. He joined us last week when we spoke to our residential community, well, a couple of weeks ago, and I spoke to our residential community managers, and he's and underwriter for OUTsurance, underwriting manager for OUTsurance, and he's going to be able to share some insight with us today. So Ashwin, maybe we could just start with a little bit of an overview on the kinds of policies and the kinds of cover that one should consider from the get-go, maybe. Let's start at the beginning.
Thanks, Louise, and good day to the wider audience. Again, pleasure to sit in this webinar. Interesting topic. I think something that's very relevant in today's, I think, in the engineering or in the built environment. So typically, if we look at the broader engineering type of products that's available in the market, your typical building contractor or guys in the small medium enterprise, they can consider a couple of engineering products that's available on the market. You get covers like plant all risk. It covers your typical yellow metal type of construction vehicles, your erection all risk type of policies where you will cater for when you are now building something like a cell phone tower, for example, and then the most common out of all of them is what we see in the market being sold is contractors all risk, commonly also referred to as contract works insurance. So I think depending on what the market calls it, one in the same type of cover. And when you consider this cover would offer you two options in terms of how you would structure the cover. It's sold as an annual contract type of policy, and it might be sold as a specific contract type of policy. And typically, when you decide what suits you as the client, the cover basically is an all risk policy. So just like the name suggests, it basically gives you cover for all risks or on an all risk basis. But very important to understand that the cover also caters for during the construction period. So very vital in understanding that. And it will cater for works damage like civils, buildings. And then there's a second leg to the type of cover that you would also consider is the liability aspect of the cover. So which lots of people probably neglect to look at. And that's always recommended to make sure when you're taking out a contractor's all risk policy, also consider the liability exposure linked to that policy as well. If you break that type of cover even further, the policy is broken down into the works damage part and then the liability part, like I've mentioned. When you're structuring your policy, the underwriter will probably require from you, and depending on what you decide, are you now going to consider an annual contract or a specified contract? An annual contract will basically mean is, if you're a typical building contractor, you would now consider, I do 3 developments in the year and a couple of odd renovations. My total annual contract turnover is, say, let's use 10 million as an example. And you'd say, I'd like to be covered for this annual contract period. The underwriter will probably structure that policy based on your annual contract turnover. Or alternatively, you might say, listen, I just landed a contract. I need to build a particular property and I just want cover for this specific contract. Then you can structure a specified contract in terms of your contractor's all risk policy. So on an annual basis and or a specified basis as well, depending on what that contractor will suit his budget. And I think it's very premium sensitive based on that as well. Then just the definition of the insured, who the insured is in terms of that product. The insured will also include the employer, the principal agent, depending on who that principal agent is listed in terms of the contract, then contractors themselves and subcontractors. And it could be any other person that's involved in the contract. For example, the actual builder or the actual tiler that will form part of the insured if and when a possible incident may arise. That will fall within the definition of the insured under that particular product itself. The period of insurance, I think that's very, very crucial in contractors all risk. Usually the market will sell this up to 24 months. So if you're taking an annual contract, it's not specifically, it can be extended up to 24 months. Ideally, it is for an annual period as well. When the contractor would when the insurer would underwrite that contractor, they would need typical information like your bill of quantities. The building contractor would be very familiar with that. Construction schedules, when you get on site, when the foundation starts and how that contract will actually progress. And then other information like your typical working drawings, what you're actually building, the plans of that project. And your scope of works as well, a breakdown of what you're actually going to do. That will typically be more related to if you're doing some additions and alterations at the premises. You're going to break this wall down, you're going to expand, you're going to build onto the premises or whatever the case may be. Then the period of insurance, the construction period, when does the cover actually start? So it typically starts based on the due date that you actually nominate, and that date is actually reflected on your schedule. So when you write that policy and your policy documents are issued to you, that date should reflect on your schedule. And it's also when the insured has taken possession of the actual contract site. So you now get on site, the work is starting, that is when the cover obviously kicks in as well. There's a handover period. So typically, when the insured property has reached a stage of completion, the building contractor will probably sign a certificate of completion to hand over that site because the work is now completed. And typically in those situations is when that handover period comes into play. In other words, the work is almost completed for that project. Over and above that, then there's the maintenance period as well. I think that's one of the points that was raised. Maintenance period is typically when that snag list is drawn up. So you're going to get a client after the client goes through the property or the renovation with the builder. They put a snag list together. That builder will obviously come in and he'll attend to it even after the work is completed. So the average commercial product will allow up to 12 months for that maintenance period to be attended to, making sure that the snag list is then sorted out, for example. You get a testing period as well in terms of contractors all risk. That testing period is when there's you need to commission something or test something. So if the contractor is now probably installing some plant and machinery in a light industrial building, so there's a period where that contractor has to test and commission and make sure that the plant and machinery is functioning and working optimally, and there's no issue. So that particular contractor can also opt for the testing period, which is one of the options on the product. Then you get a run-on cover. I think lots of people miss this. Run-on cover will typically mean when a contractor approaches an underwriter or an insurer and say, listen, I need to take out contractors all risk, but I've already started the project, or the project is 2 months down the line. The underwriter might decide, yes, is the risk feasible for us to underwrite, depending on how far that project is completed, or what point of construction that project has reached. And then they would probably decide, yes, we can assist the client, we can underwrite this policy, even though the construction has actually started at the premises. And that's typically referred to as the run-on cover under contractors all risk policy. There's a lots of extensions and clauses on the all risk policy, as typically any commercial insurance product available. But some of the important additional covers that I think a typical building contractor must also consider is offsite storage. So you're working on your particular construction site, but your actual raw materials are probably stored at your own building site. So you can actually take out cover for loss or damage for that offsite storage. Again, typical building materials and things like that you would need cover for. Then getting the stuff from that probably offsite storage to the contract site. So you might consider goods in transit cover. So contractors all risk also encompasses a bit of goods in transit, and one of the optional covers that you actually can consider if and when you need that particular cover. Then you get something like surrounding property. So ideally, as a contractor, if you're working on a particular site and you're concerned about where you're working, say, for example, you're doing an extension on a property and you're building on, and during that build on or that addition, you actually cause some additional damage to the surrounding property. That's one of the optional covers that the contractor can consider as well. And I think, of late with some of the writing and the recent unrest that we had, making sure you've got adequate SASIA cover in place for that contract. Also important to understand how SASIA will sell the cover in terms of an engineering product. So they won't sell SASIA on a group scheme type of engineering product basis. They would look at a contract all risk policy in terms of making sure you have a contract works coupon linked to that particular contractor's all risk, and therefore they'll issue you that coupon based on that product or policy underwritten. So I know it's a mouthful, but an overview of basically contractors all risk. I think it's a very interesting product and some that I would highly recommend for your SME type of businesses who are entering for the first time in the construction industry. I think it's something very crucial to consider.
Thank you very much. So I just want to kind of go back a little bit. So there's a couple of questions coming into the chat here. Just to reiterate, we are focusing on property development, but I do see that we have a couple of community managers with us this afternoon. So we'll touch on that as well, Graham. I can see your questions coming in there as well. So if we just go back a step, so your contractor, when I think of the word contractor, I think of building contractor. So in the case of this policy, we're looking at various contractors within this ecosystem. So you've got your property developer, which is obviously the business that is managing the project as in its entirety, and they are then outsourcing their services to various companies to perform during the course of the construction period. So are you saying that the contractor would be the actual developer, and then his subcontractors would need their own policies? They would need to have their own internal insurance policies in place. Is that correct?
So it's depending on how that contract was structured in terms of the main contractor and when he uses subcontractors. And I think it's important, if there's an agreement between the main contractor and subcontractors, where the main contractor also stipulates that the subcontractor must have some type of cover in place, then that subcontractor will probably take out their own contractor's all risk type of cover, or public liability cover for that matter, depending on what their concerns are. But the principal agent or the main contractor can take out one policy that will cater for the subcontractors as well, because that becomes part of the insured.
So, and that brings us to, just as you mentioned it there, liability, and this is just a question coming from Billy. What is the difference between liability and indemnity as far as insurance cover is concerned?
So, I think it's maybe it's a bit of semantics in terms of the word. So liability is to indemnify the insured if they found legally liable. So again, there's a few products out there, and if you have to maybe just separate contractors' all risk from general public liability, your typical public liability cover is more comprehensive as opposed to public liability packaged under the contractor's all risk policy. And now I'll differentiate the two for you. Is a general public liability policy will cover you, possibly depending on what the insurer will cater for, or the underwriter, it will probably cover you for any type of liability within South Africa. But if you take out liability under a contractor's all risk policy, that is just specific to the contract site that you're working at. And the difference now is there are a couple of different extensions and additional covers under public liability that you might not see it under the contractor's part, under that liability section as well.
So a contractor's liability cover, would that be something that an HOA should also consider if they are busy doing renovations and building on site?
I would recommend that. I mean, that would cater for any liability that may arise from the type of maybe odds and ends, additions, alterations that HOA is doing at that time. Or if they want more specific cover, then consider the public liability cover, which is probably a standalone that they can buy as well.
And so just on that, any persons that is building their own property within an estate or development. So I'm purchasing service land and I'm building my own property. Whilst I'm constructing my own property, should I be taking out a contractor's liability?
Yeah, I mean, if you're concerned and if you think that maybe the builder or the contractor you appointed doesn't have the cover in place as the homeowner, or you starting your project, you can also take out that cover. It's not restricted to a specific tradesman. I think the homeowner can also insure the project as well.
So, okay, so you've now started your project and you've taken out the cover, and there are obviously there are divisions within it. So you've got your liability and your construction periods and all of the kind of issues that could happen there. But then there's also your assets, so your tools and equipment, vehicles, etc. Are those covered under that clause, under the all risk, or do you need to take out other policies to cover those bases?
Yeah, so very, very important, just to give you a distinction. So plant all risk type of policy will cater for your plant, typical yellow metals type of, your motor, your excavator, your backhoe loader, and things like that. Your typical plant risk policy will cater for that. The contractor's all risk policy won't cover you for your personal tools. Now you need normal all risk type of cover for that. What it would cater for, and if I give maybe a very simple example, if you you putting up a building, it is your raw materials, your roof trusses, your brick and plaster, your cement, all of that will be catered for under the contractor's all risk as insured property. But the artisan's tools, your drills and your bricklaying equipment and all of that, you would need all risk type of cover to cater for that. That is not covered under the contractor's all risk policy.
So previously you mentioned transport. So there's two types. I see transport in two kind of ways, and I sort of stand to be corrected. I'm ordering materials from a workshop. It's being delivered to site. There's that transport, and I'm moving between sites, or I'm using tools and equipment that is used on multiple sites. I'm traveling with my tools and equipment between sites. Obviously, we hear a lot in the news about vehicles being hijacked and equipment and materials being stolen. If I think about my personal assets, if I transport my personal assets, I would make sure that either the removal company or I have covered those assets in transit. How does that apply to a property developer and or a homeowners association?
So I think for the typical property developer, tools are expensive these days. I mean, you're traveling with a bakkie with probably a generator now and some expensive tools. So again, your tools should be specified, and the coverage should be specified under is an all risk on an all risk basis or all risk cover, because you ideally will be moving from site to site. It's not linked to a specific risk address where it remains at a particular premises. So that's vitally important for the contractor to understand that they need to make sure that the equipment is specified. That's when they'll enjoy cover. Over and above the equipment, the vehicle is probably insured, or the plant all risk is insured. So that's wouldn't fall under all risk cover or contractor's all risk cover. And then if you also transporting some of your materials from site A to site B, for example, then making sure you either have goods in transit cover or you have goods in transit packaged within your contractor's all risk, to make sure that if you lose some of the materials in an accident, that will be catered for.
I have a question coming in again from Billy. He's asking if the subcontractor is covered under the same policy as the main contractor, so under a contractor's policy, do they both pay the same excess per claim?
So it'll be, the excess will be applicable to the event. So it is one event, one excess applied. Typically that's how the market will cater for that claim. So it wouldn't be an excess per insured or the person that is now covered under the definition of insured. So the main contractor wouldn't need to pay an excess, neither would the subcontractor need to pay an excess. I highly doubt that other insurers in the market would apply that way. From experience, it would be one excess per incident for the policyholder to pay.
One excess. So the policyholder in this case, who is the policyholder in this case, though?
So it
if
could
you,
be
sorry?
It could be the main contractor. So the business entity that's taken out, for example, the contractor's all risk policy.
Okay. So if I, as the developer, take out a policy that covers my subcontractors and something happens to materials or them, or something happens, I, as the developer, are liable for that excess.
Yeah, the insured in that case.
In that case, okay.
Yeah.
Unless I can prove that I was not, I can prove that it was not that item is covered under the contractor's policy.
Yeah, and I think depending on how that claim will probably be managed, maybe there might be a recovery from that subcontractor to recover that excess for the insured or the main contractor in that case, depending on what the incident was and the circumstances around the claim as well.
So I'm going to stay with Billy with this last question. He's just, well, not necessarily his last, but he's asking us, what is the best way to cover for theft, vandalism on site? Theft and vandalism, though there are two different things.
So this engineering product allows for you to specify a theft amount, and I think typically, so we must make that distinction. You know, your tools and equipment, if that gets stolen off a work site, that's not linked to the contractor's all risk policy. You have to probably put a claim against your all risk type of cover. But if there was theft of building materials on site, you know, or maybe you were now doing a project where you were laying down some very expensive porcelain tiles, and you come the next day and all those boxes are now disappeared from site. So you can actually nominate a value for the insured property and against theft, because your reasoning might be highly unlikely that everything will probably get stolen. So give me X amount in terms of theft cover, and that product can be structured that way.
I think what's very important, and you've mentioned the word at numerous times, and this affects HOAs, is the word specified. So, well, it affects everyone. What's specified? It's a specified. So how specified do you need to be? And I know this sounds strange, but if we look back 2 weeks when we had we spoke to Willem from Kingswood, one of the challenges they had is that they had a dam that was damaged in a flood. And although it said dam, it didn't specify the pump and the engine. It didn't specify down to its kind of micro level of products that are required. So would the same then apply for a developer? How does that translate across into that transitional period when you go from development to maintenance? And then, of course, how do we hand that over to a homeowners association? And how do we forewarn a homeowners association about making sure that they do have all the necessary paperwork in order so that if something happens, they are covered as well? Because that was another key area that was highlighted in the previous webinar.
Yeah.
It's a bit of a question, sorry.
Yes, so I'm going to try and break it down. I think specified in terms of context, on a commercial policy, there's many sections within a commercial policy that you need to specify certain assets or certain things in terms of that policy. But if we look at it from an engineering product perspective, and I'll give this distinction again, some underwriters might say, okay, if you're taking out an annual contract under contractors all risk, you might then have maybe one standard project that is in excess of the underwriter might say, if within your annual contract turnover, if that is say 20 million, but you have one standard project that is 10 million on its own, they would probably set a limit to say that contract now has to be specified and we won't include it within your total annual contract value. And that's when you have to make that distinction and take out a specified contract for that particular project that you're working on. Now, that's just in context of contractors all risk policy. If you need to specify items, specifying items typically on an all risk policy would mean you're listing all your items that you want to cover. I've got a jackhammer, I've got a generator and all of this. It's specified under your contractor's all risk policy. Specifying structures on a property. So in the HOA example, maybe on that particular site, there's a dam wall. Depending on how the fire cover is structured, that insurer might say you need to specify that dam, not under our column 1, which is your typical building, but possibly under your column 5, where it is more miscellaneous structures. And therefore, you need to note that there is a dam on the premises, or electric fencing, or borehole, or windmill, whatever the case may be. And that's when you specify it under that policy to then know that this item is not your typical fixture and fitting on the premises, and you're noting it specifically under that fire section. So if there's an incident where you're claiming against that borehole pump or that windmill or that electric fence, or that dam wall, or whatever the case may be, then there's specific cover within that fire section of that policy specified under that column.
Apologies. So if we look at our cover, we have, I think our construction period is, there are other risks within the construction. So civil unrest, what they call, sort of construction forums and delays. So something that could delay a construction timeline, which could incur costs for contractors, subcontractors, and also for the developer themselves. Is there a policy that you can put in place that can protect you against any of those types of delays?
So, Louise, as far as I'm aware, these policies are very much perils-based policies. So there must be an incident that influenced the work to have stopped. Okay. Your typical delays where maybe there's unrest or maybe shortage of materials. As far as I'm aware, unfortunately, the policy might not respond to something like that. If there was a fire or a flood or a typical act of, acts of nature, then that policy will respond to that. So I think it's very crucial to understand when the policy is taken out, what the exclusions are, the exceptions of the policy is, and I think that's vital.
I think also during this process of construction, if there is a claim, the claim process, the claim turnaround is vital. How long, we need to replace a piece of equipment that's been damaged or disappeared on site, and it's now urgently required to be replaced. What does the claim process look like?
I think because the contractor is who we're covering hypothetically in an engineering product like contractors all risk. So if there is probably works damage at the premises, when the claim is lodged, and let's use an example that maybe while a wall was being built, the wall collapsed, maybe because of heavy rain or so. So remember, one of the underwriting requirements on that contract would have been to supply your bill of quantities, for example. So you can quickly quantify the loss by saying 10 meters of boundary walls collapsed. Based on the bill of quantities, you can put a costing to that damage. And because the contractor is your client, you're not going to get a third-party contractor to come in to build a wall that contractor is already building. So in terms of the claims process, once you validate the claim, you quantify the claim, in all probability, that money is paid to the contractor, hopefully efficiently enough so that the wall can be built again, or, whatever was damaged in terms of that contract could be reinstated so that the work can continue as well.
Okay, so we've now, and I think that those kind of perils, as you said, it's a peril-based claim / insurance. So now we finish our contract period, we move across to the maintenance. Sorry.
Just interject. Remember, it is all risk type of cover, but the policy might have exclusions where they'll say, yes, there is all risk cover, but these are the exclusions. So some of the exclusions might still apply to the all risk type of cover. So the typical example that you encounter on a contract site is your natural perils, for typically, or theft at the contract site as well.
Okay, so I think about it in layman's terms. I can't insure my AirPods if they get stolen, because excluded on my policy are specifically mentions AirPods and headgear, and I bring it back to something that I personally have experienced. But I understand what you're saying. So the exclusions are extremely important, and it's and that obviously is something that you scrutinize from a development point of view, and you go through with your insurance, your broker or underwriter. So just on that, so now we're shifting across, because I have a couple of questions coming in again from an HOA perspective. So I apologize for jumping, but Graham is asking, he's out at Gowrie, does OUTsurance provide a risk analysis prior to quoting for protection? So prior to your, policy installing policies. This is from an HOA perspective.
Okay, so typically, yes, what we do is in terms of, and I would speak on behalf of OUTsurance, is once we quote the client on that commercial product, and if we are quoting an HOA, we then do what we refer to as a survey, or the industry might say risk assessment. So we have a specific skill set. We'd send out a surveyor, would come out to your premises. They would typically look at the premises, do a risk evaluation of the premises. Ideally, what that risk evaluation entails is determining what the fire and the theft exposures are at that risk, and whether, excuse me, and whether the client complies with many of the bylaws related to fire, for example. We'll do an assessment report. We'll communicate that to the client if there's something that needs to be rectified in terms of making sure the client complies with building regulations, for example. And then if we deem the risk acceptable, we'll underwrite and we'll hopefully onboard that client. If there is concerns and we think that the risk is unacceptable, we'll communicate that to the client or the broker or any other intermediary that might be involved to give feedback to say, we unfortunately won't be able to accept the risk, and we'll give reasons why.
Just on that, just 2 points. Pete, right at the beginning, asked us a question of whether it's important to insure residential communities after that they've been developed, and that the answer to that is absolutely. And I think that, and I stand to be corrected, but often in the Constitution or in the rules of the estate or sectional title, it does specify that insurance needs to be included, and it is a kind of a rule, and maybe one of our estate managers can comment on that, but it is a requirement in some communities to have insurance in place. And I think it's a vital part if you hear some of the risks and the damages that can incur. Just on, sorry, I'm just scrolling through my questions again. I just also wanted to note from an HOA perspective, something we learned and which isn't necessarily highlighted by the broker is the certifications of completion and handover of elements within the estate. So if you built a dam or a bridge or a road, it was built by a contractor, there needs to be an engineering certificate. And that engineering certificate needs to be supplied at the time of the claim and is not necessarily asked for at the time of when it's insured. So from your side, maybe from a underwriting and perhaps even an OUTsurance perspective, if a property developer is insuring through you from the beginning of the process, so through the construction period, across into the handover period, do they supply OUTsurance with any of those certificates of completion? Are they required to supply any of those certificates of completion?
So remember, that certificate of completion will be relevant to the handover to the third party where that project is now completed for. So we will be more concerned about the project, and that project meaning we need to understand his bill of quantities, his scope of works, and the risk associated with the construction of that tangible property. Because once the handover is completed, the insured or the contractor now hands that over. That homeowner now puts that building onto his own cover with whichever insurer. If there's an incident related to that building, depending on what the incident was, whether it was workmanship related from the contractor or the property flooded because the pipes burst, then that homeowner would have to claim under his own building's cover for his building, unless there was some liability associated to that claim linked back to that building contractor, then that contractor's public liability cover or his defective workmanship extension will respond, and then there will be an assessment based on findings of the claim, what actually happened, who's liable, and the claim will probably be resolved based on that. So upfront, we wouldn't ask for completion certificates because we're not insuring, we're insuring that contract. We're not actually insuring that asset when it is completed, unless that client wants to put it with, for example, OUTsurance.
Can I ask, I don't know if this is a silly question, but often you're developing and then later on into homeowners associations or from developer, the infrastructure around the roads could be put in by the municipality. So there's a municipality becomes one of the players in this environment. So are they then required to ensure the workmanship on the roads themselves, or how would the developer bring the roads into the policy, or can they not bring the roads into the policy?
Well, as far as my understanding, an HOA, and depending on the scope or the scale of that homeowners association, I mean, in terms of civil works on the inside of that property, that HOA would cover, and that will fall within the common property of that HOA development. So street lighting, the roads, things like that would fall within the sum insured that the HOA needs to make sure that they cater for. So any damage to that infrastructure within that HOA under that business entity, the HOA should be able to claim under their insurance on damage to that infrastructure. I highly doubt it that the municipality will come in to pay for something like that.
But sorry, let me just clarify. In some HOAs, the roads aren't owned by their homeowners association. They're public roads owned by municipality. Well, they're public roads. So, so damages caused to the public road is not necessary. Is that then would not necessarily be covered by an HOA policy?
Yeah, I guess in that sense, if the HOA is not responsible and it's the municipality's responsibility, then I highly doubt it that will be included as part of the sum insured that the HOA would nominate to cater for that.
Sorry, guys. The HOA, I'm trying to see a way for them to get their roads covered. So just another question coming from Billy. How and when does force majeure come into play?
Yeah, that's, I think, quite a technical term. I think to actually give a very comprehensive answer on force majeure is difficult now. It's a bit of a stumping question. Maybe I can do a little bit more. A better, a more comprehensive response to that question either offline. But typically, it is part of how that claim will probably be settled based on whatever the circumstances were on that force majeure.
Okay, so sorry, we put you on the spot there. We can we'll definitely connect you, Billy, and we can then discuss that offline, or perhaps you could share that definition with us and we'll add it to the webinar when we distribute the content. So we're wrapping up our last few minutes. Shan, there's a question coming in from one of the attendees, but if you could put your questions into the chat box, I'm more than happy to ask them. Unfortunately, this isn't live insofar as the attendees can come into the webinar to ask a question directly. Please feel free to pop it into the chat box and we'll get to it. So I just want to cover, so there are mentions of other policies that relate to property developers, a business all risk, building cover. Do these differ from what we've discussed from a contractor's all risk to a business all risk? When would your business all risk become required?
So your business all risk is basically to cater for equipment that you move around with.
Okay.
So typically a tradesman's tools, you look at a medical professional, whatever he moves around with in terms of what's in his medical bag, for example, to your average web developer who moves around with a MacBook, So Your business all risk type of cover basically caters you for items that you move around with. And typically that policy also covers you or gives you worldwide cover. And the difference between that and contractors all risk is the contractors all risk is basically just covering you for the contract that you're actually busy with and separating your equipment, which needs to fall under a separate section of commercial cover, which is business all risk cover.
So I think I'm sorry, there's just got Lisa's coming in with a question. Say, for an example, tsunami damages the complex, so water damage to the complex. That is a force majeure, a natural disaster. Is that correct?
Yeah, I mean, I'm not too familiar with the term, and that's why the term stumped me a bit. But like I said, I'll probably just do some homework and and give more feedback on that.
Okay, so let's just have we've spoken about our cover. From a property development, the cover comes into play from the date of the start of the policy as specified in the policy. It runs until through the construction period. At that point, we then need a different policy or a slightly amended policy that takes us into the maintenance period, because your cover changes, and I assume then your premiums and etc. might change as well. At the beginning of this webinar, you mentioned that you could take an annual policy out that is sort of more all-encompassing versus specific to each and every project. An all-encompassing product, will that include both timelines, so maintenance and construction, as long as it happens within that period?
So remember, your maintenance period and your handover period and your testing period are all extensions within contractors' orders. So whether you opt for the annual contract or the specified contract, you can specify timelines based on, for example, the maintenance period. You might only offer 6 months, for example, or you might only want cover for 6 months based on the maintenance period. So yes, these different time periods can be structured within the contractor's all risk policy, either on annual or on specified.
Okay, so the base, obviously the cost will play a big role in which type of policy you take out and how it looks, and the structure of each business as well. So and I think maybe as we round off, because we've come to an end of our 45 minutes, I just want to quickly touch on claim. So the devil's in the details. It always comes down to the process of something happens and now you need to claim for it. And it's that point when you discover you're missing paperwork, or you're missing something, or, there's an issue with or a conflict or issue with regards to the claim. Can you summarize how can a developer, a brand new developer working into the space, or an existing HOA, make sure that they have crossed their T's and dotted their I's, so that when it comes to the claim process, they've got what they need to be able to put that claim through?
Okay, Louise, I think it's also important to understand the context of the claim and the merits of the claim and what was actually damaged at the time. So if it is major infrastructure, let's, for argument's sake, say if it was a building that burned down, I think what's crucial in terms of the underwriting, was it an approved structure? So the municipality will have details of the approved plans, because rebuilding, your sum insured must cater for the fact that you might need professional fees involved. You might need to redraw plans. So having documentation, you might not have it on hand, but you can obtain it from various sources. Again, like maybe getting the municipality, plans that were now saved in their archives, for example. Other structures, if you had a retaining wall built, and it was approved by the engineer. Now this wall, for whatever reason, from storm is damaged and it collapses. To reinstate that wall, I think the validation process is very key in that sense, to make sure it was an approved structure, it was built according to what the engineer actually specified. So these are some of the validations that an insurer will go through to make sure the claim is within the ambit of the cover. It is a valid claim, yes, and they would basically indemnify the client. So you're going to get instances where the structure is probably 15 years old, that maybe that engineer is no longer in business, or you don't have that records on at hand. I think the test will be, if that structure was now submitted for approval now, would that structure based on that spec be approved? And if you probably answer that as yes, then I think, in my view, you shouldn't have an issue in terms of making sure that it should be part of a valid claim.
Thank you so much. And as you're saying that to me, I'm thinking about, there's, especially here in the Western Cape, there's a number of heritage sites that need to be included in the development. So even just down the road, you've got a beautiful development going up. It has an existing building that's part of, is a part of our heritage. And so its value is maintained. The challenges perhaps are getting the original approved plans on a building such as that, should something go wrong. So there certainly are, it's something to remember, and certainly are some challenges around it. And for HOAs, it can become a real challenge when there is flood damage, and perhaps if anyone is in that situation, please feel free to go back and have a look at our webinar from 2 weeks ago, the 20th of April, approximately, where we did speak specifically to HOAs around those types of issues. But thank you again, Ashwin, for sharing your time and your knowledge with us. And please, if you would like me to would you like to be put in contact with Ashwin, please can you drop me an email, and I will happily do that. Clem, if you could put my address in the email box. Thank you, in the chat box, sorry. Thank you very, very much from everybody. And for all of those who gave up their lunch hour, I hope that you found that this webinar interesting and engaging. And please stay with us for more to come, and as we continue to speak to OUTsurance about the insurance, navigating insurance landscapes. Thank you so much. Clem, you pop the video on, and have a good day further.